Okay, so welcome everyone, and it's nice to have you here. So I'll be your host for the evening, and today we have a very exciting webinar on tips to fund your analytics startup. This is being conducted by Ajay Lavakare. The webinar is happening as a part of Data Fest 2017, as you all know, and we are in the last week of this month-long festival. So make sure you participate in all the upcoming competitions. There's a skill test, machine learning skill test, which will be happening on 29th, and on 30th we'll have a 6 hours mini hack. And these are the opportunities that you may actually seize to rank up on the leaderboard. So if you still haven't checked the leaderboards, please go and check your leaderboards. There are cash prizes worth rupees 1,80,000 up for grab. So I think I can start the session now. Give me some time. Share the presentation. So we are here tonight for the webinar on tips for securing funding for your analytics startup. The speaker with us we have is Ajay Lavakare. He is one of the most active angel investors in this space. Today, he's going to share some tips with us on how to secure funding for your analytics startup. Those of you who are building your analytics startups, I'm sure this is an extremely beneficial webinar for you. So before I introduce Ajay, I'd like to bring him as a panelist. So Ajay Lavakare brings in more than 25 years of cross-cultural experience and into strategic domains, and across various industries. He has worked in like Japan, the US, and in India. He is an IIT and Stanford graduate. Ajay really enjoys mentoring and guiding entrepreneurs. He's actively investing in B2B companies involved in data analytics and open data and helps them expand internationally. His current investments include Attitude, Innovator, Loginex Solutions, Smart Virex, Fieldworks, VideoCan, and others. He started his career as a software engineer in Japan and moved to India to become an entrepreneur. He founded RMSI, one of India's leading geospatial solution companies. He's also spent some time in Silicon Valley with Risk Management Solutions Incorporation. He has also been investing through Indian Angel Networks and Stanford Angels and Entrepreneurs India for over 5 years now. Personally, I would like to say like Ajay has been very closely mentoring analytics Vidya for quite a long time, and it's been really a delight to work with him, and his guidance has always been fruitful to us. So, okay. So let's start this session now. Ajay?
Yeah, Deepika, can you hear me?
Yeah, Ajay. Welcome to the webinar.
Great, thank you. So can I take over now?
So Ajay would like to have a few polls before we start the session.
Right.
So just to understand the audience, so I'll just quickly launch one poll.
Should I give back control to you for the poll? Because I think it's got.
I have it. Guys, you can start polling. So this question is, how many of you are entrepreneurs and want to be entrepreneurs? Okay, we're still just 2 seconds more. Okay, so let me just share the results. So more like 43% of the audience wants to be an entrepreneur, and there is some audience who is already an entrepreneur. Okay, great. So I'll have one more question. So if you are an entrepreneur or are in the early stages of your venture, what would be your current funding status? If you haven't voted yet, please do that. Few more seconds and we'll share the results. Okay. So 58% audience is looking for funding, which is definitely the agenda is all about. Okay. So share the results. About 8% of the audience, the venture is already funded. Okay. We have one last question. Just launch polling. So how are you looking to fund, or have you already funded your startup? So 50% of the audience is looking to fund the startups through incubators and accelerators, and 10% each for family and friends and other angel investors. Share the results. Okay. So Ajay, you can take over the controls and you can start the webinar.
Okay, I'm assuming you can see my desktop, right?
Yeah, we can.
Okay, great. Well, thanks, Deepika, for the introduction, and good evening to everyone who's joined. This webinar, I'm going to talk about securing funding for your analytics startup. As Deepika has already introduced me, my name is Ajay Lavakare, and I'm hoping that maybe I'll spend the next 40 minutes or so talking about the topic at hand, which is the tips for funding, and then the remaining time we can use for Q&A. So in order for you to actually appreciate some of the content, including the tips that I'm going to be providing in this session, I think it's very useful to have a good understanding of the kind of landscape. That means understanding the funding ecosystem, actually taking a second look at your own funding needs. Then I'm going to help you understand how investors evaluate entrepreneurs and their pitches. So you understand kind of the basic scorecard that investors typically use to evaluate the entrepreneurs and their business plans. One of the topics that I will talk about is around valuation, because whenever there is a conference or a seminar on funding, somebody always asks the question, how do we figure out valuation? So I thought I'll talk a little bit about valuation, then summarize some of the content, including some additional tips for fundraising. Hopefully by the end of this you have a good idea of the ecosystem, you have a good idea of the evaluation criteria, and you actually might have some new ideas of your own on on tips that you can share with your colleagues as well. And of course, we'll end it with some Q&A. So let's talk about the funding ecosystem. And I've kind of put together a pyramid. The pyramid actually indicates more the size of funding or the size of capital that is available in each of these layers or each of these participants in the ecosystem. And typically when you enter, when you start a venture, you're going to enter from the top. You're going to either be looking at funding this by yourself at the very beginning, because you may not even have a plan. You may just have an idea. You may decide that you need some equipment. You might want to maybe license software. You want to pay a consultant who's going to help you develop a prototype. So you might look at your savings and fund it yourself initially. You might also have what are known as the 3 Fs: friends, family, and fools. So these are typically, either your parents that might give you some money. Either it could be in the form of a loan. They might even give you the money, and you might issue some shares to them. This is done very informally. Similarly, friends might do the same thing. They might give you some money and say, listen, whatever, just give us what you think is fair. And often the friends, family, and fools round, or your self-funded, is typically in the range of 0 to 50 lakhs. So you might get your first 50 lakhs of funding, whether it's a loan, whether it's equity, from either your self-funded or these friends, families, and fools. The second entry point actually could be an incubator or even an accelerator. I noticed in the polls that some of you have looked at incubators and accelerators. So for those of you who are not aware of what these are, so incubators and accelerators are often very early stage vehicles for helping entrepreneurs. So incubators are often come in at the very first stage. They could even replace your self-funding or your friends, family, and fools round. Because you basically come into an incubator with nothing more typically than just an idea. And within the incubator is when your idea gets hatched. It actually becomes real. You may not even have a team when you enter the incubator. Accelerators, on the other hand, it comes slightly later. So when an accelerator evaluates you as a potential candidate for acceptance into the accelerator program, you might already need to show that you have a team. You might even have to show an initial business plan, maybe even an initial prototype. So definitely accelerators are come at a later stage. I'll give you some examples of incubators and accelerators in India. So incubators, some that are well known to me, are the Amity Innovation Incubator. The Amity Innovation Incubator specifically lists, in fact, analytics and big data amongst its focus areas. So if you're thinking about incubators, that might be a good one. Khosla Labs, which is founded by the famous venture capitalist Vinod Khosla in India, in Bangalore. They also list big data analytics as one of their focus areas. Amongst accelerators, you may have heard of some of the more famous accelerators in the US, Y Combinator and Techstars. Typically, they have a fixed formula, so they will give you, if they accept you in their program in a particular batch, they will give you maybe $100,000 and take typically 7 or 8% of equity for it. And there are certain accelerators that do not take equity. So an example is Stanford University has an accelerator called StartX, and they will actually, it's only meant for Stanford founders typically, but they will not take any equity. So they actually just help the entrepreneur accelerate their business. So as I said, the funding from incubators and accelerators might go typically from 0 to 50 lakhs. These are just broad guidance numbers. They could change depending on the circumstance, depending on which incubator or accelerator you enter. The first sort of a formal round of funding at a slightly larger amount that you will be negotiating is typically in your angel round. Let me also just name a few accelerators in India. I talked about the US ones. So GSF Accelerator in Gurgaon is a well-known accelerator in the NCR region. Microsoft and Chiron are well-known accelerators in Bangalore. T-Labs has a presence in both Bangalore and NCR, and all of these accelerators have done have helped ventures in the analytics, big data, machine learning, and AI space. So you'll find companies in these spaces have been accelerated by each of these ventures. So coming down to the angels, so angels can come in actually three different forms. So the first is that you could actually go to the 10 people who you want to help you fund your venture. So you might hand select these 10 people and say, listen, I want, as an example, a very favorite of many analytics startups, angels is Rajan Anandan, because of his Google connections. You might say, I want Rajan Anandan to be one of the angels. Similarly, you might say, I want Sharad Sharma and I want so-and-so. So that is one approach where you kind of look at all the angels in the ecosystem and you identify, handpick maybe 10, 15 of them, and you approach each one individually. Another alternative is that you go to an angel network. So example of angel networks, I'm a member of the Indian Angel Network, which is the largest angel network. Now in our network, we have over 400 individuals. Usually these are high net worth individuals. Many of them have been entrepreneurs or are currently entrepreneurs. Many of them have technology backgrounds. And you pitch only once. So instead of the first approach where you have to go and pitch to maybe 15, 20 such individuals, here you may pitch only once or twice to the entire group. And then somebody within the group will raise their hand and say, I like this pitch, I'm going to lead it. So you have within this network, you have somebody, maybe one or two of the members of the network, who basically will need to say, I like it enough to lead. And once they sign up to lead, they will then negotiate the terms, the valuation, other aspects of your startup. And then it is their responsibility to actually get the 30 or 35 other angels who will invest to collectively maybe say raise a round of 3 crores. So let's take, supposing you are raising 3 crores with an angel network such as IN, you might have 2 leads, and then you might have 30 other angels, each of whom has put in maybe 10 lakhs. So you get a total round of maybe 3 crores. So the positive is that you only pitch once or twice to this network, and you deal only with 1 or 2 leads. The flip side is that you can't choose rarely can you choose the remaining 30. So you might have 30 other people who are invested in your company who you may not even know, or sometimes you may not necessarily want. Of course, there are ways that you can keep out certain people, but by and large, the people that you deal with are the lead group. So we talked about individual angels, we talked about angel networks. The third is you can go to a platform like Let's Venture. So once you get selected by Let's Venture team, you kind of are your deal is put on the platform, and you can then select the angels who are on the platform who you want to show the pitch to. There is a concept of a lead. You do need to have a lead member who is leading the deal. The lead member will help answer questions. But here, becomes more of a kind of a platform, and people like myself might sign up on a platform, look at the deals, and if you invite me to take a look at your deal and I'm interested, I will make a commitment on the platform itself. So those are 3 kinds of angel deals that you might, or angel funding vehicles that you might consider. Then the next stage is actually venture capital. That is officially called as your first formal institutional round of funding. So once you have maybe you have a business, you have clients, you're showing growth, then you are ready perhaps for venture capital. And venture capital can go anywhere from 1 crore to 1,000 crore. Some of the top venture capitalists in venture capital firms in India include venture capital firms like Sequoia, Lightspeed Ventures, Accel Partners, Nexus Ventures. So these are well-known venture capital firms that will fund in multiple rounds, and they might fund as much. They could go up to several tens of millions of dollars in several rounds of funding. And you've read about some of these VCs funding e-commerce startups, up to even $1 billion. The next level is private equity. I won't talk a lot about this, but examples of private equity firms in India. So there is the Khazanah Nasional Berhad, which is the Malaysian government sovereign fund. So these are large private pools of money. So they invested, for example, in fractal analytics recently. And then last, of course, there is the IPO and capital market, where you might, eventually, if you're successful, you might list on a particular exchange. So examples in India, tech startups that have reached the IPO, some well-known names include, InfoEdge, Naukri, Make My Trip, and then I think Infibeam was another recent one that raised capital. So one of the important things that I'd like all of you to think about is actually evaluating your funding need. The question is, do you really need funding? And often the answer might be, no, I don't need funding. Sometimes entrepreneurs don't think this through, and they just, at the start itself say, oh, I need to go for funding. I need to go through this pyramid. I need to start with maybe some friends and family. Then I need angels. Then I need multiple rounds of VC funding, Series A, B, C. Then I will go for IPO. But I think you need to really think about the need for funding. So for example, if you are doing a services business, an analytics services company where you're maybe focusing on a particular kind of service offering to a particular sector, there's a good chance that your service itself can be profitable enough and it can generate spare cash to continue your growth, and you may not need funding at all. So often companies that actually need funding are typically, and I don't want to stereotype, but more often than not, you'll find product companies do need funding because their product requires resources and money to develop before it can be sold or before it can be licensed. But there are businesses that do not need funding and are bootstrapped from the beginning. The advantage of bootstrapping, so bootstrapping means you kind of, you're on your own and you don't take anyone's money, your own money, or it's money that your business generates. The advantage of bootstrapping and keep bootstrapping for longer is that, remember, whenever you raise money, you are giving up equity. So the longer you can bootstrap, the more valuable you can make it, the less you will dilute and the more you will hold of your company. So if you start diluting at a very early stage, it's possible that by the time you're done with all your funding needs, you may only hold at the end of it a few percentage points of your company. So bootstrapping, trying to manage within your means for as long as possible, making the company as valuable as possible before you raise even your first rupee, I think is very helpful. Not everyone can do it, like I said, but I think services businesses in general have a very good chance of growing without needing funding. Then the next thing to do is so why do you really need funding? And what will I do with this money? So this is very important. You answer that along with the question of how much will I need? So some of the needs maybe for funding, like I said, if you're developing a product, the product might take 4 to 6 months to develop. You might need to hire a few people. They're expensive, software developers. You might need a UI UX person. You might need to spend a little bit on marketing. All of that costs money. So you're going to try to make a budget of how much you need to get your product to a certain stage. And each player in that ecosystem expects you to get to a certain stage. So for example, friends, family, and fools might only say that, listen, as long as we've given you 30 lakhs, try and get to a point where you've actually got a product and you've got a few paying customers. Angel investors might say, listen, we need you to start showing phenomenal growth to a point where a venture capitalist becomes interested. A venture capitalist might say, we need you to continue growing so that you can maybe go IPO, or maybe you can go to a Series B or a Series C round where we can exit. So each of these will have certain expectations. So think about how much money you need. You might need money over time, so you might have to define milestones. There might be what are known as tranches, which means the money is conditional. So for example, let's say I've committed to give you 1 crore in an angel round. I might say that I'll give you the first 50 lakhs without any conditions. But before I give you the second 50 lakhs, you need to achieve the following things. You need 5 paying customers. You need to have shown that you can, that this problem is solved in under 3 minutes. There might be some performance criteria. There might be some quality criteria. So there might be some benchmarks or milestones for tranching. Rounds basically involve follow-on funding. So for example, after Angel, you might do a Series A venture capital round. That might be followed by a Series B and a Series C. With each round, ideally, the company keeps growing in its value And while the amounts might keep growing as well in terms of your need, so Series B, you might need more than a Series A, but hopefully you're giving away less because the company is more valuable. And finally, all of leading, once you've understood your funding needs, then you start thinking about who is going to be the best investor or the best set of investors for me. So I think if you can think this through and lead this analysis and have a very clear view of what kind of investors you need in order to achieve your goals, in order to achieve your funding requirements, that would be better than kind of blindly going to the first known name and saying, will you fund me? As part of that, one thing that often I think entrepreneurs don't do a very good job of is understanding the investor. Remember that fundraising is a lot like a consultative sales process. Okay, you are selling something. What you are selling is your business plan and your idea, and that is delivered through a pitch. When you sell, all good salespeople know that you need to understand your customer. You need to have a very good understanding of their needs, and then you need to match the features and the functions of your product or whatever your service selling to those needs. So the sales process is very similar to raising money. You need to, first of all, understand the investors and understand what their needs are, what are they looking for, and then figure out if there is a match between your capabilities, your business, and your needs with what the investors are looking for. Typically, investors could come in three kinds. Again, my presentation is going to focus more on the angel investing because I think most of you are going to be in that phase. Those who have already reached venture capital funding probably don't need this webinar at all. They've already gone through a lot of these. So I'm going to be focusing more on the angel investing stage. So there are essentially two kinds of investors and one hybrid. So some investors are very strategic in their investment in terms of they have a particular thesis. So, and sometimes you will actually find this thesis listed on the website, whether it's a LinkedIn profile of an individual or on the website of a fund. They will list out their investment thesis. And I'll give you some examples. So, Kashyap Devra in his book Golden Tap talked about the thesis of rocket internet. And what he said was that they had a thesis of what he called the this of that. So they said, if we're looking in India, we're going to look for who is the next Uber for India, or who is going to be the next Airbnb for India. And so that was their investment thesis. So they were looking for companies in the consumer internet space that were going to be the this of that. And Analytics and Applied, our AI investment fund, an early stage fund, has two very clear theses. So the first, they believe that applied AI is going to create new category leaders in India, particularly in sectors like healthcare, where AI technologies, advances in computer vision, sensor technologies, NLP are going to create very compelling solutions, and there are going to be category leaders. Their second thesis is that these category leaders need to build in India. India is a very good place for such companies to be built because A, they can build data sets at a very low cost, and B, they can get great data science, machine learning, and AI talent from companies like Microsoft, Google, from their India offices, because you find trained people, or even in startups that are doing interesting data science, analytics, or machine learning work. And they also foresee great exits. So that is their thesis. Similarly, if you look at an angel investor like Sharad Sharma, I won't go into his investment thesis, but he has very clear investment thesis of beliefs that he lists out on his profile in Let's Venture, for instance, including a thesis for analytics. So we don't have time to go into that, but look at what these theses are. Another type of investor says, listen, I don't have a thesis as such. I'm looking to create a diversified portfolio. If I invest in 20, 30, 40 startups and I do a good job in my due diligence, I do a good job with checking out various things, and I have a good chance that out of these 40, maybe 10% or 20% of them do really well. So out of 40, I will have probably 3 to 4 that are great multi-baggers. They will give me 8x or 10x my return. And so my job is to build a large portfolio that's fairly diversified. So that's called a diversified strategy. And there are others that kind of have a combination of both. So when you look at what are angel investors or what are investors looking for, one, they're looking for a validation of their thesis. So if they have a certain belief, does your business plan validate that belief? Also, they might be looking at diversification. Does your business help them in their diversification? So for example, if an investor already has a portfolio or has invested in 3 companies in the healthcare analytics space, they may not want a 4th investment in healthcare analytics. They might look at an investment perhaps in edtech analytics or fintech analytics to diversify their portfolio. Or they might say, I've already got too much in analytics. I want actually something in non-analytics. Maybe I want something in HR as an instance. That might be another example of diversification. Also, typically for good investors, they want to give advice. They have gone through perhaps the entrepreneurial journey themselves. They believe that their advice could make a difference. So sometimes they want to actually help. They also want to learn. So often, investors will invest, particularly again, angel investors will invest in a company in order to learn more. They are interested in a space, or they have gone through a certain experience. They want to kind of see if there are alternate ways of doing something, and your startup might be a good experiment for them. So some of them might be actually putting in money to learn. And it's not one of these, it could be a combination of these. And last of all, almost every investor is looking to make money that's commensurate with their risk. And often that means that they are looking to exit or leave your company at some point, selling their shares to someone else. So what is this checklist that investors use to evaluate entrepreneurs and their business plans? The first, there are kind of 6 broad criteria that investors use for this evaluation. I'm not going to go over each one of them. One I've already covered. So for example, I talked about the thesis fit or the appropriate diversification. I will cover 3 of them. I'll talk about the team, I'll talk about the differentiators, and then I'll talk about exit. And there's a separate section on valuation in any case. So let's, to me, the team, when I look at my spreadsheet, while I do evaluate all of these, to me, the team and the differentiators are the 2 biggest ones. So I give a lot of weight to the team. I give a lot of weight to the differentiators, the unique selling point or the value proposition. And of course, valuation does matter as well, and we'll be talking about that. So when you're evaluating the team, obviously investors are looking for passion, they're looking for enthusiasm, and this is across the board, whether it's your family that's going to lend you or give you money, whether it's your friends, whether it's an angel investor, whether it's a VC, they're all looking for this enthusiasm to see whether you believe in your own idea. They're also looking to see whether you have the ability to learn, because often your original idea is going to change. You're going to find something that you realize that, oh, wait a minute, I need to modify my approach, or maybe I need to pivot, or maybe I need to take a brand new approach. And so investors are looking to see if you have this ability to learn and flex and change and pivot. There's also the educational background and of course experience. What have you done previously that might be relevant to the current business that you're doing? Educational background can be interesting. Some investors want a tier A degree. They say, oh, we will only invest in IIT, IIMs. Others investors say, actually, we will never invest in any company that is IIT, IIM. So that can go both ways. But definitely investors are interested in looking at the educational background. Track record is another very, very important aspect. Has the team done something, or has the entrepreneur or the founder done something similar or in an adjacent space where we can then believe that the entrepreneur has the ability to succeed because of a past track record. Understanding of the space is another important. So having domain expertise. Now, I'll give you an example. If I see a team consisting of 3 founders, let's say all of them from triple IT, and they're all techie, I actually will worry. And the reason I'll worry is that I don't think the team has diversity. It's not well-rounded. They're all in the same background. They're all engineers. They all have, tech backgrounds. So I worry, for example, then who's going to bring in the sales expertise? Who's going to bring in the domain expertise if they're solving a particular problem in a domain? If they're all the same age, often having a diversity of age also helps. Having somebody who's a little maybe older, wiser, been through it, has some gray hair, might be paired up with somebody younger who maybe is the techie. And so looking for diversity, maybe having a combination of men and women in the team also can make a difference, because that brings in more ways of thinking into the team. So this diversity is also very important. And then you form an opinion on whether this team has the ability to execute on what they are promising, and will they be able to scale? Because at the end of the day, the company has to grow in order for your investment, you being now the investor, in order for your investment to grow, the company has to scale. And so you are also evaluating whether whether the team has the ability to grow large and continue to manage the business. For me, this becomes very important. So, why will this team win? And how will they continue defending what they have done and continue winning? And honestly, I feel this is also the hardest part of the pitch. How do you, if you're an early stage company, you have maybe an idea, maybe you have a prototype, how do you prove your differentiators to the investor? And I'll give some examples of ways in which you might consider trying to differentiate. So one might be a unique set of capabilities or knowledge or experience within the team. So for example, if one of your founders has done something very similar before, has been successful at doing it, that itself is a differentiator. Very few companies have successful founders who have done something similar. Another might be exclusive access to data. So maybe you have some kind of a special relationship with somebody like, let's say, Facebook. You get special access to their APIs, or you have something with Amazon, a partnership which is very exclusive, or even a particular supplier of data who does not supply this to anyone else. That could be a differentiator. So you are the only one who has access to this relationship or this data set or this API. The third might be that you already got some intellectual property. So you might have patented something, you might have some very deep technology, so there are only 10 people in the country that understand this technology. So that might be another differentiator. And although this last point on network effects are must-haves, now in an early stage you don't have the network effect, but investors do consider whether the network effect is possible in your startup. And what I mean by network effect is that as more and more people use your product or your service, does the value to them increase exponentially, typically to the square or to the cube? Or is there a way by which your product or service becomes a must-have for a particular industry? So it might start off as a nice to have, but eventually it becomes something where it is absolutely a must-have. So you look at ride sharing or even Airbnb, they all started off as nice to have, right? We had our taxis, we didn't need necessarily ride sharing. So they started off as nice to have, but today, you actually can't do without some of these services. Facebook is another example. It started out maybe as a nice to have and today becomes must have. Facebook also has a network effect. The more people come onto networks like Facebook or Ola or Uber, the more value actually you get, both from having more drivers and more passengers. So companies like that actually build these network effects. So there's an evaluation that investors do to see if these can be, if a company has this ability. The third aspect of the checklist I want to talk about was exit opportunities. Remember, I said that investors do want to make money. They're taking a risk. 8 out of 10 investments for angels will fail. So the two that they do well, they want to get a significant return to make up for the 8 that have failed. So there are typically a couple of strategies that you might think about and talk to the investor during your pitch. It's very simple to say, IPO or buyout, but I think it's good to think through and about how an investor might exit. So an example, particularly for analytics and data science, machine learning startups, is you actually go with the strategy of saying, I am going to look for a company I'm targeting to be acquired by these kinds of companies. And the acquisition could be even just a tech acqui-hire, that your team gets acquired, not so much your IP. So an example, Little Eye Labs is often quoted, a Bangalore-based performance analytics tool provider for mobile app development. They got acquired by Facebook, and it was an acqui-hire. Facebook was very interested in the developers that were building these performance analytics tools. So when they acquired the company, they actually moved the team, I don't know how many, 10, 12, 15 people, to Menlo Park in the Bay Area. So that was an example of an acqui-hire. A second might be that the technology that you've built is really good, and a strategic investor might want to buy this. So an example, again, is a company, one example I can give is the Marketelligent, which was a platform, a company in Bangalore. They built a platform to collect insights from and patterns from big data, particularly in the retail and financial world. And the technology was very attractive to a company like Brilio that bought them, I think, they acquired them for $70 million. So an acquisition can happen for either because your team has got some great skills and a company is interested in these skills, or you've built some technology that is really good and a company wants it to maybe supplement their product, or it could even be a competitor who wants to take you out so that they don't have to share any of the future revenues with anyone else. And then another example might be in a winner takes all situation. So especially in competitive markets, in particularly consumer internet space, you have maybe 2 or 3 companies that will eventually survive. So let's take e-commerce. You have Amazon versus Flipkart and maybe Snapchat, Snapdeal, but it's only going to be eventually a 2-horse race. And many of the VCs who invested in these companies, they either got bought out. So investors in Snapdeal will probably get an exit when they get acquired by Flipkart, or you have investors in the Series A or Series B, or even angel investors in someone like Flipkart. As the company kept raising more and more money, they got bought out in subsequent rounds of funding. IPOs are very rare, honestly. So if you said that, oh, I'm going to exit through an IPO, I don't think it's as compelling as, let's say, choosing to build to flip or a winner takes all exit strategy. There have been some IPOs. We talked about, InfoEdge and Make My Trip, Infibeam, Justdial, but there are only a handful of tech companies, really startups, that have gone IPO. So briefly going to touch on this valuation topic, because that again is often a big mystery. How does valuation get decided? And I will tell you that valuation, again, it's a cliche, valuation is an art more than a science. But there are several ways you can think about valuation and perhaps use some kind of a triangulating approach. Try to think about valuation from multiple perspectives and then arrive at a particular valuation. So the first is how much money is required. So remember, you did that exercise of identifying how much money you need. So that becomes one factor. Okay, do I need 3 crores or do I need 30 lakhs or do I need 30 crores? That becomes one factor that affects valuation. The second is the investor's evaluation of, if I give this money to the company, how big can the company grow with this money before they're going to need the next round? So there's this evaluation an investor makes saying, okay, if I put in 3 crores, can the company become valuable to, let's say, the tune of 30 crores or 50 crores before they need more money, where I can then perhaps exit. So this is the investor's evaluation of how big can the company grow. And so maybe they're willing to put in 3 crores for 10 crores because then they have a good sense that you will be able to take the company from a 10 crore valuation to perhaps a 50 or a 60 crore valuation with the 3 crores that they give you. We talked about the evaluation criteria scorecard. So remember, we talked about the team, the market size, the exit opportunity, all of those. So that also affects the valuation. If you score highly on these evaluation criteria and you are an interesting prospect for an investor, there's a good chance that you get a higher valuation. Then there's comparables. So I'm going to give an example. Let's take a hypothetical example. If Analytics Vidya decided to raise money in, let's say, an angel round, and they said, okay, how do we go about figuring out a valuation? So the first thing that someone like Kunal would need to do is say, okay, first of all, how much money do I need? Well, maybe I need 3 crores. And the reason that I need to raise the money is because I want to build some capability in the US. I'm going to have some marketing expenses. Maybe I want to add some great content writers to it. Maybe I need to build a much better platform. So I need 3 crores. That was the first piece. Then let's say he went to an angel fund. The angel fund is going to say, well, Kunal, we think they're going to make their own estimate of how far will this 3 crore take Analytics Vidya. Then they will look at all those evaluation criteria, the team behind Analytics Vidya, their unique proposition. So one example, unique proposition for Analytics Vidya may be that they are the largest community for data science, and it's unlikely that there are going to be multiple such communities. There's going to be a winner takes all. So that might be one competitive positioning. They might also have competitive positioning to say that we know all of the data scientists in India really well. Nobody knows them better than us. So that might be another example of competitive value proposition. Then to comparables. So then Analytics Vidya would have to look at other companies that have raised rounds of funding. So they might look at Kaggle and say, well, how much did Kaggle raise in its first round? Oh, they raised $3 million at this valuation. And usually some of this data is available through places like Crunchbase, or if you just Googled on the internet, Kaggle fundraising, you might get some ideas, you might get some data. Another example might be looks at Stack Overflow. So because or looks at a tech recruitment site that has recently raised money, or looks at maybe HackerEarth that has raised money, and so these become comparables. So you get an idea of how much did these other companies that are in similar businesses raise and at what valuation. So in this way, you can triangulate. The amount of money you need. Kind of how big the company can grow with this money. You have a sense of comparables. And then lastly, of course, it's down to negotiating. Remember, I talked about the sales process. Very similar in the sales process, you have negotiations. If you have other offers, ideally, that puts you in a strong position. If you have very little cash left, you're running out of cash, you're going to be in a weaker position when you negotiate with your investor. So to summarize now, I'm just going to conclude with some that I've already covered, maybe some new points. So the first, we talked about remember to research your investors. Don't just go blindly to investors. Think about their investment thesis. Do they have a thesis? Are they diversifying? What kind of investments do they make? So for example, if you looked at my LinkedIn profile, you will see that I don't invest in typically consumer internet startups. I don't invest in fashion. I don't invest in pets. I don't invest in food. So, if you send me a pitch, or you think that I'm not a good candidate if you are doing an analytics startup for pets, because I don't invest in that space. I don't invest in B2C consumer. I invest in B2B. Now, if you're doing something using data analytics and open data, let's say in the ed tech or the healthcare space, B2B, then I might be a good target investor, because I have already invested in this space. I understand it. I'm obviously excited about it. I believe in it. So that's an example of creating a short list of investors based on your understanding of how they invest and what they invest in. So don't waste your time with investors where there's no fit. The second thing I'll say is warm introductions are always better than cold calling. Again, it's a sales concept. In sales, if you can get introduced to a prospect through someone who is trusted to both, that is, the prospect knows your potential client, your friend or your connection knows your prospect and knows you well, that will be far better than cold calling. So again, when you think about your investors and how to approach them, I would strongly recommend that you not cold call them. Sending a LinkedIn request is much less likely to get a connect than if you go through a connection through LinkedIn. So if somebody else introduces you and says, hey, I want to introduce you to this person, I already know the person, I trust them, I'm going to listen to them, I'm going to have a meeting with you, or at least hear your idea out. So always try to go through introductions from your network, connecting to their network. I've talked about the evaluation criteria. Now remember, in analytics and data science, machine learning can be quite complicated, and do not ever assume that your investors understand this technology well. Even if they have invested in analytics startups or in AI startups, you should ensure that you keep it simple. You try and explain as much as possible through first principles or simple explanations about the technology, but more important, try and explain the business problem that you are solving. Investors often are not investing in a pure technology. They are investing because you are solving a particular business problem. In the Silicon Valley, show rather than tell is very important. So if you look at pitches in the Valley, often the entrepreneur will whip out their laptop and show a prototype. They might bring a product prototype, proof of concept to the pitch, and they would first show it. And showing rather than a long pitch and just talking about something that you plan to do, showing that you've done something is always far more engaging than talking about it. So for example, if you can show how your predictive analytics model is currently solving a business problem, and you can actually pull up a few screens where you've solved a particular problem, that's always more compelling than a PowerPoint slide deck. We talked about lead investors, particularly with angel groups. You don't want to deal with 30, 40 people. You want to have an investor, and often angels will follow other angels. So if there is a strong lead, you will have other angels following them. And lastly, have backup plans. Sometimes funding might take longer than you've planned. It might not happen at all for a while. The market conditions may not be good. There could be 100 reasons why you don't get funded. So I will conclude by saying that understand the overall ecosystem. Think about your own funding needs. Understand the evaluation criteria that we talked about. And then follow some of these other tips about who you want to get in touch with, how you want to get in touch with them, what you want to say, showing rather than telling, and having backups. So that we'll move to Q&A.
Thanks, Ajay. Thanks for the wonderful session. And moving on to the Q&A. So first question is from Ravi Teja. What are the analytics startups that are funded in India? And he wants to understand what kind of analytics startups are being funded.
Sure. So, there's obviously a lot of coverage about startups that get funded, whether that's through VC Circle, Tech Circle, Link 42, lots of places where you can read about this. But from my own perspective, I'm always interested in analytics startups that are solving a particular vertical problem. So rather than horizontal analytics, so let's say, you're building up an interesting platform. I feel that today there is a lot more interest in using analytics, using predictive modeling, using data science, machine learning, AI, applying it to solve particular business problems. There are huge areas where lots of problems exist in India and abroad, and I'll give you some examples. Healthcare is a very good example where there's so many problems to solve. So healthcare analytics is a very hot area. There are actually dedicated funds that are investing in healthcare companies. There are funds that are not dedicated, but doing a lot of investment in healthcare analytics. So actually, if you look at at an early stage venture fund like Ventures, go and look at the 6 companies that they've invested in. 3 of them are in healthcare analytics. 1 of them is in energy analytics. I forget what the other 2 are. So favorite areas, vertical areas. That means fintech or solving an analytics problem, or using analytics to solve a financial problem, whether that's in the consumer lending space, whether that's in the small and medium enterprise lending space, whether that's in the understanding consumer behavior on credit cards. So lots of areas, but I would go by vertical: healthcare, energy, edtech, fintech. These are areas where you apply your analytics rather than horizontal plays, saying that, I'm building a generic machine learning algorithm and an app, and it can be used in multiple use cases. I think you lose focus if you are not solving a specific business problem.
Sure. The next question is, so what should be the ideal size of the team?
So it really, again, it depends on the stage. So let's assume that you are in the very early stages of a startup and you are looking at either an accelerator program, or you're looking at angel funding. At that point, the founding team could be anywhere from 2 to 4 people. Some people say 3 is a great number. Others say we can even live with 2 founders. Others like to see 4, where one founder is tech, one founder is sales, one founder is domain, one founder is kind of ops and finance. So it varies really. The founding team could be anywhere. I think a single founder is rare. When investors worry that if something happens to the single founder, what happens to the company, and therefore what happens to their investment. The team itself might be just the founding team, at a very early stage. If it's a small startup that's maybe looking at funding to the tune of 2 to 3 crores, they might already have maybe a team of 2-3 other people. So the total team size might be 4 or 5 or 6 people, 2-3 founders, 2-3 other programs. Some said there might be a couple of developers, backend or full stack or UI, UX. You might have somebody who's kind of the business analyst. You might have somebody who's kind of got a technology, 1 or 2 people in the with technology background. Somebody might even have possibly ops, finance backgrounds.
Okay. Yeah. Okay. So the next question goes for the valuation. How can one have right valuation? Should one look at only the past performance or also look at the future expected growth rate into the consideration?
Yes, I will just point to my previous slide, right? We talked about triangulating valuation. Valuation is not based on one single factor. And in fact, it's not based as much on past performance. It is past performance is if you demonstrate that you've done what you said you would, that obviously helps. But frankly, valuation, like I said, is a function of the amount of money you're looking to raise, the investors' belief in how much you can grow your company based on the money you've raised, the investors' belief in your team and the scorecard of other things we talked about, defensibility of the value proposition, traction, and then your negotiating ability. So, those are all things that go in determining comparables. Are there other companies? So it is not one factor. It is a complex function of all of these that come in determining, and the function is not defined. It's different depending on different circumstances. Very rarely valuation is defined. So as an example, the accelerators often define the valuation upfront. So it doesn't matter what you say, they are going to give you $100,000 and they are going to take 7%, which means they're giving you in effect a valuation of $1.2 million post money. So they fix it. So it doesn't matter. But in most other cases, whether it's angel, whether it's a VC, valuation is this complex function.
Sure. Yeah. Next question comes from Manish. He's asking for analytics startup on manufacturing IoT. Is there any recommendation for venture funds?
Yes, like I said again, I talked about Pi Ventures. They are also very interested in companies that are combining IoT with machine learning, AI. So there are funds that are very interested in IoT, and these are early stage funds. So they look at, they will give you anywhere from 1 to 3 crores in funding. So if you are able to meet their various criteria that we talked about in this presentation, there's a good chance. So yes, I would say there is interest, but you have to pass the test of having a great team, having a defensible business, having some traction, having a great team itself. So all of those things we talked about.
Okay. Yeah. So I'll just take a few more questions. So what are the 3 main investors in the field of data science?
Sorry, what is the question? Which are the
3 main investors in the field of data science?
So again, I don't know how to answer this because it really depends on which part of the ecosystem you're talking about. So if you look at accelerator programs, I talked about several accelerators. I don't know which one's the largest, but I know Microsoft is well known, T-Labs is well known, GSF is well known. So those are well known accelerators, and all of them do data science. They not exclusive, they do invest. They're very interested in companies that are using data science, that are using machine learning and AI. If you look at angels, you have a list of top angels who invest. I don't know who might be the top 3 for data science per se, but in general, the same names will often come up. So you'll have the founders of Flipkart, you'll have people like Rajan Anandan, you'll have Kunal and Sachin and Binny. Those names often come up. So you have these lists of angels who are very active, and I don't think the lists are compiled necessarily by data science or analytics, but the good news for everyone who is thinking about analytics as a startup is analytics is hot. It generally gets more interest from investors than many other areas. So most investors will have some exposure to analytics in their portfolio. If you look at venture capital, the top 3 venture capital firms are Accel, Nexus, and Sequoia in the country. If you look at venture debt, you have basically 2 large venture debt funds. I don't think we covered venture debt in our talk, but basically they give you debt rather than take equity. They might take a little bit of equity, but they give you unsecured debt, so you don't need to have hard assets like property. So examples would be Silicon Valley Bank, India, Trifecta Capital. These are top venture debt funds. So in each segment of the ecosystem, you have key players.
Okay. Okay, Ajay, thanks for the session. I think
so. There were 2 more. Sorry, Deepika, remember there were 2 questions that came in prior to the. So one of them, I think, related to ask the question on pets. I'm just going to look at the email. So they said, "Oh, I have a startup that is looking at something to do with pets." And so honestly, like I said, I don't know a lot about pets. It's not an area that I invest in. I did take a quick look to see kind of what are the pet startups. So this startup, the gentleman or the person is doing a startup to analyze dog activities. So my first reaction is that it's quite specialized. So the market opportunity or the size of the opportunity might be quite small. The pet startups that are getting funded are typically one-stop shops that do a whole lot for many pets. So they do everything from grooming to a marketplace to training to food to couture. So because the space itself is quite specialized, they do a whole range of services, and they don't just focus on dogs, they focus on all pets. So that's how they increase the market size. So one of the challenges I think you might have in your dog activity tracking business is that it might be a very niche business, very small market size, and therefore may not be of interest to investors. What you may need to do is maybe, and again, I'm no expert on this, but you may need to think about adding more capabilities, more services, so that the market size becomes more attractive. And take a look at kind of other pet startups and see what their strategies have been. Then another question somebody had asked was, what are the chances of getting funded for AWS Redshift-based analytics startup? Again, I can't answer this question based on this limited information. I do need, you'd need to provide much more information. And it's like a consult, it's like when you tell the doctor, "Oh, I have a pain, give me medicine." Or, you go to somebody and say, I want to join your company. There's a much more involved process, right? You kind of have to understand what is the business. You have to understand what is the opportunity, what is special about this business. So I can't give a direct answer on what are the chances for getting funded for AWS Redshift-based analytics startup. But I can say that if you follow the various things that I've mentioned, try and address the evaluation criteria, follow the tips on approaching investors, your chances improve. That's all I can say.
Okay. So, okay. Thanks, Ajay, for taking time out and interacting with the community. I hope we really have benefited a lot with this session. And for those of you who have been following it from the beginning, we started this webinar with the simplified understanding of funding ecosystem with some great examples. And we generously covered how investors evaluate business plans and how you can understand an investor's mindset while discussing some practical fundraising tips in the end. Thanks for the session, Ajay. Hope to see you again at the Data Fest.
Oh, thanks, Deepika, and thanks everyone for attending at this late hour.
Yeah. So a few announcements. So this webinar will be is recording live on Facebook, and also the recording will be available on the YouTube channel. One more announcement. Tomorrow we have a keynote session by Mr. Shrikant Vilamakani. He is the co-founder, Group Chief Executive, and Executive Vice Chairman of Fractal Analytics. Don't miss the session. The session is on AI revolution, and hope to see you there again. Thank you, everyone. Thanks a lot.
Okay, thanks. Bye, Deepika. Good night.
Good night.